Welcome to Module 1, Part 2. In this video, we will explain why investing beats savings, how compound interest works, and what the golden rules of investing are. As mentioned in Part 1, you can avail of a savings account rather than investing, but money in a deposit account will lose value due to inflation over time and will only earn very little interest. The global stock market has increased its value by 7 to 10% every year, even during years of financial turmoil, including 2008. Compare that with current interest rates available for savings accounts, and it's easy to see that investing gives you greater earning potential. For example, let's look at €5,000 invested versus €5,000 put in a savings account during the years 2015 to 2020. By the end of the 5-year period, the money deposited into a savings account has decreased by 3% due to negative interest rates and inflation, whereas the money that was invested has grown by 62%. If you refrain from withdrawing your invested money, you can benefit from compound interest. Simple interest is when the interest is calculated only on the initial investment. Compound interest is defined as the interest you have earned on your original deposit combined with the interest you have earned over a defined time period. If the interest rate stays the same, you'll earn more each year as your interest compounds. Compound interest can apply to both savings accounts and investment accounts. Here's an example of how it actually works. Let's say you find an investment that offers a return of 7% per annum. A return is defined as the total income an investor receives from an investment every year. It is quoted as a percentage of the original value of the investment. If you invest €1,000 into an account that offers a return of 7% every year, you will earn €70 in interest, making the total value of your account at the end of 1 year €1,070. Using the same interest on that €1,070, at the end of year 2, your account will be worth €1,144.90, as you're beginning to earn interest on your interest. Your pot will grow even if you don't make any further deposits. The amounts might look small at first, but the results, as time goes on, can be very dramatic. Compound interest grows your money faster, resulting in great growth. For this reason, it's worth starting to invest early, as it can have a significant impact on your wealth in the long run. Now you can see how much investing can benefit you, especially over the long term. Before we get into more detail, I want to outline the 4 principles of investing. You can think of them as the golden rules. We'll keep referring to them as we go on in the course. Think long term. Investing is not a get-rich-quick scheme, nor is it guaranteed to be successful every time. Studies show that the longer you stay invested in the market, the better your returns will be. We'll be explaining more about that later on in the course. Build an emergency pot. Life comes at you fast and there are no crystal balls, so as much as we would like to put all our excess money into investing, it's a very important rule of thumb to keep some access to instant money available to you. Unforeseen costs come up despite our best efforts, so build an emergency pot that can get you out of a jam. Investment goals. Before you start investing, it's important to know your why. It'll help you to define your goal and motivate you to keep investing. So ask yourself, why am I investing and what do I want to achieve? The next question is, how long can you invest for? It's important to take into account your time of life and what is next on the horizon for you. What are your plans over the next 5 to 10 years? The answer will be very personal to you. For example, it could be buying a house, funding education for your children, starting a business, or for your retirement. It's difficult to plan a long-term future and it can seem very daunting. Talking to a financial advisor can help you eliminate any stress and clearly define your financial goals with simple steps along the way. Luckily, as you're a member of the Goodbody Investment Club, you can avail of a chat with a Goodbody financial advisor free of charge. Email us to find out more. Diversify. The final golden rule is diversify. You will hear it again and again as we go through the course. Diversification in finance simply means not putting all your eggs in one basket and spreading your wealth into different types of investments. Soon you'll learn what types of investments suit you best and what you need to be aware of when putting your plans together.